let's go back a week. So if I go back a week to last week, really all I want to focus on is a couple of things. First of all, we'll just touch on this briefly. Our GDP numbers. This was the final numbers for quarter two, right? Remember, they give us an advanced number. A month later, they give us preliminary numbers. And then a month after that, they give us the final numbers that they're going to lock in. And so didn't change. Basically coming in at 3%, which isn't weak. It's actually quite strong for a big economy like the US. So good. We've got a strong economy. Then we've got the all favorite personal income and outlays that was reported last Friday. Now, if we take a look at that, you're going to see as we look through all these numbers that, man, especially this core PCE price index month over month, I mean, this is right within where the Fed wants it to be. 0.2, 0.1, that's where the Fed wants this number to be. And so that means that they have succeeded in getting inflation under control in, compared to history, a very short amount of time, like 18 months. So, okay, great. Now let's go back a notch and let's come back to this week. This week, I mean, I guess the most important thing was today. Let's go ahead and just bring ourselves to today. Today, we got the employment numbers. And what did the employment numbers tell us? Let me go ahead and just filter this economic calendar so that it only shows us the United States stuff. So I'm going to add a little bit of a adder to this URL, and that's going to make it just for the United States. There we go. So we got our employment situation this morning, and people were on pins and needles. What's it going to be? What's it going to be? The Fed has spent the last 18 months aggressively controlling inflation. What are these employment numbers going to be? Well, guess what? Strong as shit, man. Especially compared to last month where they came in sort of weak. I mean, non-farm payrolls, they were expecting 132,000. They got 254,000. Not only that, they went back and looked at those pretty crappy numbers for August and upped them almost, 17,000. You look at the unemployment rate, ticked down again. Last month it ticked down, which was confusing because the unemployment rate ticked down, but so did jobs. Well, the unemployment rate continues to tick down. This is great news, right? Private payrolls up way more than expected. Manufacturing payrolls, we're still losing some manufacturing. Participation rate, I've talked about that in the past. I always look at this number. This talks about how much of the people on the rolls are actually in a job. And 62.7, good for now, hasn't been the best as it's always been in the past. After COVID, it kind of dropped down, but I'm okay with that number. And, just seeing average hourly earnings being up, seeing the average work week coming down, that means people are, getting a little bit of reprieve from all the work that they've been putting in. This is a really rosy employment situation. Combine that with the fact that inflation looks to be under control. I mean, this is the Goldilocks situation. The only thing that could be, one tad better would be if people felt it at home. And if you look, at the numbers and you look at people's personal balance sheets, they should be feeling at home, but emotionally, a lot of people still say that they don't feel good at home. And that might have to a lot to do with, how polarized the country is in this whole political thing, which I don't even want to get into. But I mean, if this this is the soft landing that everybody can dream of, that nobody expected the Fed or the fiscal, group to pull off. The fiscal group is, of course, the politicians. Nobody thought that they could do this, but it looks like it's happening. And if it stays, through the end of this year, Sip, I mean, that is going to be an absolute miracle, and everybody should be celebrating.
Yeah, I feel like the reaction from this, or I don't feel, but the reaction from this was that the expectation for the next cut kind of dropped a little bit, right? It went
I
like
mean, check this out, Sip. I'm going to zoom in on this one. Forget the even border to my browser. I'm removing this. You got to see this. So this is saying that the next cut, I mean, it's at almost the market is pricing it in as we speak. It's like almost unanimous. It's not unanimous, but 9 out of 10 of the folks in the CME survey are saying that it's only going to be a quarter point next time. But I want you to look down here at the fine print. 1 day ago, yesterday, that same number was only 68%. So we jumped up, 22% here to get to this 90.5 in 1 day. And that's because of the employment report. It wasn't so straightforward. In fact, a week ago, this number was under 50%. It was 46.7%. A week ago, it was almost a given that we were going to be seeing, we were going to see a half point again. And now it's a given that it's only going to be a quarter point. And if we fast forward a little bit, I always like to look out through the end of the year. If you look at the December numbers, again, I've got to point out that what they're saying here is that in December, it'll be another quarter point for a total of a half point, a half point coming up and a half point in December. But you look just yesterday and it wasn't that agreed upon, right? The number at 75% now was only at 43. It wasn't even, a consensus. It was more like, we think that, just a week ago, it was almost a given that it would be at least a 1.25 point total, not 1 point total, including, for the whole year, a 1 point drop. That's where we're going now. But just a day ago, a week ago, they were thinking that it would be more aggressive than that.